Good morning, everybody, and good morning to my panel, and thank you all for attending. Certainly enjoyed the two panels earlier on this morning, or the Fireside Chatham panel, and a lot of intel on trust within this sector. And I'd like to just start off with my panel just asking them to introduce themselves briefly, and then I will try and set the scene as to where we are with a clear focus of structure and how we ultimately get a positive, hopefully, response, as long as they don't all think that we're at a dead end with regards to the mining sector, a positive response to how we can bring green money into this. So I'll start off with Camilla on my left and then just go down.
Good morning, everybody. My name is Camilla Hughes, and I'm really delighted to be here to talk to you today. And thank you, Jamie, for hosting the panel. So my background is in both investment banking and technology. Investment banking has covered a lot of different jobs, but the common theme has been effectively raising capital and also supporting companies in managing their relationships with investors. And clearly, ESG, as we all have heard a lot about it in its many different forms, is very much, part of that discussion today. I formerly have led the ESG advisory work at Rothschild's, and also I sit as a non-exec of a PLC in the house building sector, so bring hopefully some of that discussion to this meeting today.
Nicholas Boyd-Mathews, very pleased to be here. I've actually flown all the way from Australia, so you'll forgive me if I'm a little bit jet-lagged, but thank you very much, Jamie. My background, 34 years in the industry. I worked in London for 15, 20 years before emigrating to Australia. Mainly in asset management. Eden Asset Management is a company that I founded sort of 11 years ago. We have a natural resources fund that invests in mining, and it's an ESG light green Article 8 fund. So our aim is to influence companies to become sustainable through a roadmap that we've developed, and we're here hopefully we've been nominated for an award in ESG Initiative of the Year. So very pleased to be here. Thank you.
Pavel.
My name is Pavel Aberko. I'm with the Emerging Markets Investors Alliance. We are an NGO focused with a mission to implement best practices in sustainability with a focus on emerging markets. We do this by educating companies and investors in various areas of sustainability, and then organizing the process of engagement and dialogue between issuers and investors and making it more effective. My background, as all members of our alliance, I used to work in investment management for many years as an analyst, head of research, and portfolio manager.
Good morning, everyone. My name is Mark Wade. I work at Allianz Global Investors and in the Sustainability and Research Group, focusing a lot on the sort of thematics, sector and company profiles and how we engage on that. But I also I've covered metals and mining industry for several decades now.
Well, thank you very much indeed. You can see with that panel, we're definitely going to get to a conclusion on this. So I'd like to just set the scene. I don't think it will be a surprise to any of you that we need a step change in the supply of raw materials, and that is underway at the moment in order to meet the transition to a sustainable future. None of this is possible unless we get the investment into the sector. I think it's depending on which survey you look at, there's $1 trillion or so required in order for CapEx to meet that supply by 2050. In fact, BlackRock recently put out some research, Brown to Green, which was in collaboration with BHP, where they highlighted for copper alone to meet those requirements, that $250 billion is required of CapEx by 2030 in order to keep on track, and only 50 billion has been earmarked so far. So there is significant underinvestment going on in this industry. There's a disinvestment going on within the sector on an equity basis as well over the course of the last few years. Yet at the same time, we've got extremely strong balance sheets. We've got an extremely exciting demand outlook, but we have a valuation which is roughly 40 to 50% lower than where we were in the mid-1990s on an EV/EBITDA basis. The pool of capital is shrinking, and we've got to turn this around. I'd like this panel to consider three key questions. The first of all, what has gone wrong? Where are we? Is this addressable? And ultimately, what are the levers of change that need to take place? So I'm going to start this off with Mark at the end from Allianz to say, what has gone wrong, Mark? Where are we? And perhaps maybe give us a bit of a colour with regards to where you see the mining sector from that basis relative to other sectors.
Thank you very much, Jamie. So, what's gone wrong, and I don't want to reiterate what was in the last panel, is, there was an issue of distrust. And that's translated in recent years to more specific, the transition from qualitative to quantitative. And so, Rohit talked about it, the screening of the industry. It is a high impact sector on environment, social. It flags in certain areas on governance. But what's the real problem here is as metals and mining has had the challenges over the last decade in terms of its performance versus indices, it's become less relevant. And so when I say that, it's not because it's less relevant to the future of the global economy, it's become less relevant from an investment perspective. It is now 1.3% of ACWI. You're asking people at a time when single stock sell-side research is the worst it's ever been. I've been looking at sell-side research for over 30 years now. It's a complex story in tough markets when everybody's complaining about the resources to analyze. The industry needs to make it easier for people to invest in this industry. And so it needs to play catch up. Is the sector improving? Yes. Is it improving relative to other sectors and the broader improvements we're seeing? I don't think it is. So it needs to be much more proactive, to what Jamie was saying, in order to create that marginal buyer coming into the industry.
Okay, Pavel, perhaps from really an emerging markets point of view, I mean, could just expand a little bit basically on what Mark's just said, but perhaps also highlight, is the sector apologising too much for its legacy? And how does it look at, so to speak, from an emerging markets point of view, where you've got that particular interest? So many of these mines are in the emerging markets world.
Yeah, so following up on Mark's introduction and responding to some people who say that it's all because of the ESG and the rise in ESG investing, that the mining sector is not popular anymore. I would say that the world is changing, and investors and stakeholders reassess and reweight their investment criteria. And this is not just driven by ESG, which is not really some kind of a theme or a fad. ESG integration is partially driven by the changes that we're seeing in the world, but also many of the factors and risks related to ESG have always been with us. And I would even say that investment managers looked at many of these factors even before the term ESG was created. I mean, if we look at climate change, it's not a result of a rise in ESG investing. Other issues such as rising tensions between the employers and employees in many cases, between companies and local communities, they always have been happening even without any relation to the rise in ESG investing. And by the same token, corporate governance has always been a very important criterion. Personally, as an analyst and fund manager, I always looked and tried to assess the quality of corporate governance, trying to answer the questions such as, what is the composition of the board of directors? What is the approach of the company and management to minority shareholders? What is the strategy of the company? So many of these questions are old and have always been raised, but some of them are new and coming up right now. So basically, to summarize, I would say that industries and companies need to adjust to these changing world. And many companies do and do it rapidly, but other companies are lagging. And that is, in my view, a problem, if not the problem.
Thank you very much indeed. And perhaps sometimes adjusting to a new changing world can be learnt from other sectors. So Camilla, you've got a wide experience across many different sectors within the lens of sustainability and investment. What other sectors can this industry, which I think is behind the curve in so many different ways, yet at the same time, some of the leaders of the industry, if you take some of the bigger companies actually in the top quartile of the ESG numbers, if you take Thomson Reuters data. But if you look at it from a total industry, we haven't quite measured up, we haven't kept pace with some of the communication, some of the capability that other sectors have kind of led and taken the front foot forward. Perhaps highlight, just maybe comment on some of those sectors.
No, absolutely. I mean, I think just sort of taking a few of the sort of prior comments, which is that, you know, industries have their own inherent risks around ESG, and each industry and each company is on a very different kind of trajectory on the path of kind of improving towards the sort of common goals. And in other industries, I think, as we were saying, you know, this industry is a little bit behind, and other industries, I think, are slightly further ahead in terms of realizing that actually grasping ESG and using it as a framework in order to describe and set out what the priorities are of the business and actually where the risks and opportunities lie is actually a positive way of actually communicating with investors in order to effectively deflect the kind of nervousness and the risk around the unaddressed issues of the past or the actual unanswered questions in the room, or actually, you know, the historic reputational issues that sort of come and go with, again, certain industries and also certain companies. And that does take time. So again, without repeating sort of other panels, but you know, the trust and the time are very key elements to this, and I think other industries are sort of further ahead with that. But also importantly, using that data and realizing that data has a value. So if the trajectory of ESG is the sort of push factor, so it's understanding the regulation and it's understanding the requirement to collect data and in particular sort of, you know, measure carbon and actually start to work out what to do with that data, it's actually enabling this sector to move ahead into the sort of pull phase, and then turning those those words into actions. And so that's, I think, where other industries have really started to look for specifically at new sort of supply chains, new ways of actually putting their products and their services together, and potentially then using that sort of innovation to start thinking about what a pro forma model or a pro forma business model looks like. So, for example, in the house building sector, actually starting to look at, you know, different types of products that effectively enable a company to produce exactly the same product, but with a sort of different set of materials, which actually comes with a different set of carbon data and a different set of sort of ESG data on the whole. So, in a way, it's an enormous exercise, isn't it, with ESG? And I think companies can be very frightened and very defensive, and I think that's where we're at, particularly with this sector, which is defending why actually companies still need to continue doing things as they've done it in the past. But actually the important piece, and where other industries have come to, is actually to realise that actually crossing the line into thinking about doing things differently is actually where you start to see real progress. So that's the usage of data, the value of data, and actually how to turn ESG into value creation. So, you know, if that actually is leading to customer, you know, what customers want, and it's also leading to revenues in a new and changing market, and in addition to that, if actually managing risks better means that you've got a better monitoring and management of costs holistically, you actually end up realizing that companies that really grasp ESG, you know, will actually prosper and also will flourish over and above those that will get left behind. So it's highly linked to competitiveness as well. So without kind of going into the depths of other industries, what my experiences have been working across many different sectors is actually really supporting businesses to understand, you know, what they can do today from where they stand today in both their operations and their collection of data, and then actually how to then use innovation and technology to think about the future in a different way. Now, a lot of these younger businesses are actually really adopting that much more quickly. So again, the age of a business and where it sits in its sort of legacy issues, so to speak, actually does really impact actually how it can attract capital, and also how it can use its data in order to then articulate its investment case and give confidence to what the future returns are going to be. So there's a lot in that, which obviously is also predicated very much on sort of the communication and the ability to have the trust on what the businesses are saying and actually what they're doing. But it's a myriad of issues.
You brought up one thing in there about effectively it's what the customer wants. And I think sometimes the mining industry doesn't totally always, certainly a lot of the mining industry doesn't always recognize exactly there is an end customer here. It gets sold into a market and it goes down the supply chain. Apple, I think, came out several years ago as the largest consumer, coming out and saying they needed to know where every single pound or ounce of metal had come from, and have taken significant action on the back of that. I see the finance industry as almost an agent of that ultimately supply chain, in terms of the going through certain hurdles in order before it gets into the supply chain and then going on from there. Do you see, from an ESG point of view, if it's done correctly, if it's done on a value add basis, do you see there's a compliance angle and then there is a beyond compliance which can add that extra value to the company? On the compliance side, I see it's difficult for the mining industry or for any sector to be able to differentiate itself. It's always going to remain relative. How can we effectively increase the confidence and trust to ultimately allow investment to go through and therefore be the agent to see those commodities go into the mining sector? Into the supply chain.
Yeah, and I think you're absolutely right. I mean, ESG, especially at the start of any kind of ESG strategy, is all about the kind of governance and compliance, because you've got to start somewhere, and that's what the framework provides. How you then move that forwards into the value creation piece is very much around how do you then integrate it within the strategy. And the strategy is obviously what underpins the investment case, and that's ultimately what the investors are looking for. So there are a number of difficulties here. As Mark said, if it's a small part of the indices wherever you sit in the world, then obviously it is potentially an investment opportunity which can be overlooked. And if the issues and the discussions are complex and the risk is relatively high, there's a time issue here, which is how much time is an investor going to put to this. So it needs to be a sort of a dual-pronged attack, which is actually that if businesses can demonstrate that actually they have a strategy which provides the economies with the supplies and the goods that customers need and want, and again you can argue that for many of these critical commodities it's still quite a small part of the overall commodity spectrum, but it's growing, that there is actually sort of absolute necessity to get that capital to work to support those products and services. But it is very much building blocks towards actually sort of, this is what the investment case looks like, and this is what underpins it, which is the values, the trust, and also the data, which really gives the confidence that the models on the investment portfolio manager's desk actually can produce. And I think the only other thing to say there is that realizing as well that there are different pools of capital with different risk appetites that are relevant and suited to different opportunities. And sometimes, and in my experience as well, it's very often the case that there is a frustration where it's a really good business can't actually raise capital because they're just talking to the wrong set of people. So whilst we've got a very much a homogenous issue in climate transition and a homogenous issue in how do we all tackle ESG, it actually means different things for different parts of the community. And I think that's really understanding where advisors can help, and also really understanding that what needs to be done needs to be also very much directed at the right set of people. And that's the information that needs to be put across clearly.
Okay, thank you for that. And I'm going to come to Nick in a minute, because Nick's got a really interesting resource fund which is Article 8 approved on sustainability. So he is in the industry anyway. So I'm just going to briefly, if I may, Nick, just go to Pavel and Mark. Through what Camilla's just been saying, is the mining industry able, through the lens of sustainability, able to build that trust and therefore build up its position within, if it's 1.3% mark at the moment, to go back to where it was, make it more relevant? Is it able to do that?
I think it's an exciting time, and regulation and exciting rarely go in the same sentence. So, but what I would say is, with the UK SDR that's come out, it's brought transition finance to the table. The UK waited for 2 years to look at what European regulation did, sort of saw where it went wrong, and it's come up with its own idea, and it's brought what's a new category called sustainability improver, and is really focused on transition. And interestingly, that's created the European regulation to formally embed transition finance into the SFDR framework. If you look at what's being developed in Asia, the Asian taxonomy, they are very focused on transition. And so we need to think about who, again, the marginal buyer of this industry. Are they integrated ESG or ESG risk focused, looking at risk materiality? Are they looking to be sustainable, very much looked at a lower footprint? Or are they impact, focused on the handprint or solution based? Once you know how and where you fit into those categories, and this is a sort of a quickly evolving area, then you can see how metals and mining can fit more easily or less easily into those categories.
Thank you. Pavel, very quickly, do you want to add anything to what Mark just said there?
I think I'm optimistic. Of course, I think that many things can be improved and can change. And based on our work with investors and companies and policy experts from other NGOs and civil society organizations, there are a few things which investors are looking for and they would like to see, and maybe then companies could change. So very, very briefly, disclosure and transparency are the first very important and crucial steps. And here we would suggest that the companies shouldn't limit themselves to the local regulations, but they should follow best practices and benchmark themselves at global leaders, especially if you are a global company and you want to be compared with other companies working globally. So international investors will definitely look favorably on that. Another important thing is to set and publicly commit to targets such as net zero targets, using the principles of free, prior, and informed consent when dealing with local communities, implementing health and safety standards developed by the international labor organizations, eradicating modern slavery along the value chain. So these are very important issues. Also, it's always a good idea to have your goals and targets verified by an independent third party, be it a Science-Based Targets Initiative, for example. Many mining companies submit their assets to an audit by the Initiative for Responsible Mining Assurance, IRMA. They have this famous IRMA standard, which really consolidates best practices in different areas of sustainability relevant to the mining industry. So if you submit your assets to this audit, they will show you what the gaps are between your performance and the best practices. Another important indicator which I would recommend is if companies issue labeled debt, be it sustainability-linked bonds or use of proceeds bonds or loans such as green bonds. This is a very positive indicator, especially if you do it in line with widely accepted standards issued by EMIA. For example, we issue enhanced labeled bond standards, or the Climate Bonds Initiative and other organizations. They issue standards, and if your loan or bond is in line with these standards, it really reduces the risk of greenwashing in the eyes of investors. So, yeah.
Thank you very much indeed. And that brings us on to a nice time. So Nick has got this a fund based in Australia. It is a resource fund. As I say, it's Article 8 approved. The previous panel, 2 panels before, just highlighted the need to build trust through delivery of promises on key delivering on promises that they had previously been made and held accountable, which others have just mentioned this. How do you incorporate all of this into your fund? And so we can get a better insight for some of the audience too, who may be looking for investment.
In a word, challenging, I think. Very challenging indeed. I've been doing this for over 34 years and sort of more focused on natural resources. I think if we sort of put the industry into context, though, it's all about exploration, really, and a lack of exploration that's gone on for many years. And if you talk to sort of mining companies, they have a duty to sort of get shareholder returns at the end of the day. So for years and years and years, they've been focused on not spending too much money and putting it all in the ground. Now they're being told, you've got to embrace this sustainability in ESG, which is a cost, and it's not cheap. So this is an industry that's capital intensive, doesn't always succeed, because of course mining takes a very long time, especially exploration. There's been a lack of investment in exploration for many years. It's quite obvious that we do need to invest in mining. That's quite simply to get climate change, to where we want to be in 2030. So I would say it's very challenging. I think what we do, which is we hope is going to work, we don't know, is that we take on a process where we will introduce a roadmap with companies. And that's adopting the E, S and G and all the codes by Europe. So we will go out to mining companies, we will sit down with them, and our job is to, I suppose, if anything, we have a responsibility, not just a job, to try and influence companies to become sustainable. Because at the end of the day, it's our money that's being invested, and that will influence those companies to actually adopt ESG. So I think really a lot of the responsibility rests on the asset management industry, if anything, to how they deploy that money into the market. But it is challenging, and I think it's going to take a good few years. I don't think we've necessarily got it right. I think it's evolving, and it will change. But sort of being based out in Australia, it's quite interesting. When you mention the word ESG to people, most people sort of blank face. What's that? What does that mean? You have to explain it to them. So it's not that well known out in Australia, and of course it's not regulated in Australia. But I will say that mining is embracing it, and as always with mining, they do tend to, particularly Australia, they do tend to focus on the environmental side. They've been very good on that for many years. But the answer is they could be a lot better. And if you look at the industry, there's probably, I think if I take the Australian market, which is probably, there's 2,000 exploration companies that need capital and lots of it to spend to develop a mine. Most of them don't necessarily go into production, so that money's lost in the ground. And I think I'd probably quote, if I may, Mark Twain, who sort of said, what's the definition of a mine? Well, it's a lie stood on top of a hole. Which I think still stands today almost. But I think we will get there eventually. But I think it's important to recognise that it is very new, and I'm sure it will change over time as we sort of evolve.
Thank you for that. I want to go on to the third part, which is really how we address this, or what levers need to be pulled over the next few years. And I think others in previous panels says we haven't got time to wait to address this. The critical mineral industry is upon us, and we need to make sure we're designing, developing and operating these mines sustainably and responsibly today. You just mentioned, Nick, that it's your money, and there's effectively a reputational risk through that, which comes back to you. So I'll just ask initially Mark and then go down a couple of other people. And I want to come on to other parts of this in terms of the levers as well. We've got the circular economy, which needs to be very much included. This is not just a primary supply. But Mark, reputational risk. Can the mining industry ever be involved in an impact fund? And if so, how do we get it over the line?
Yeah. Again, I'm going to repeat its role that it can play in transition, both its own transition and its contribution to the transition of the global economy. Reputation is based on doing what you say and having a thorough understanding as to the risk materiality. That reputationally, that often comes down to board expertise, board and senior management alignment, and the risk frameworks and the recognition of what's going on. Regulation is changing. The German Supply Chain Act, you can't ignore that. If you're thinking about the events around water, water is now the most recognized as the most significant physical risk that we face. And this impacts the sector in two ways. One in terms of the availability for its own use, and one in terms of its impact on the water for everybody else. So there's a lot that it can play a part in this. And you talked about the circular economy. There are some big questions here, which is, of our sourcing of metals, how much needs to come from mining? We have very poor recycling rates. If you look at what's happening in other sectors, whether it be the sort of fashion industry, whether it be the tech industry, around the notion of planned obsolescence. Planned obsolescence has been a massive part of the globalization trend for the last 3 decades. And if you go back to the last section, this is out of sync with the expectations of sort of Generation Z and millennials. So I think we have to really think about how we address those core issues and enhance the reputation, both in terms of understanding and in terms of implementation.
Thank you. Camilla, reputational risk has been a big issue with regards to the defence industry, which I think you've had some involvement with. Can we learn from that in terms of trying to pull levers to encourage new money into the mining industry?
I mean, I think each industry has got to look and learn right the way across the spectrum and learn from each other. I mean, there are challenging industries, but ultimately, I mean, ESG is completely synonymous with basically a good business with good business ethics and actually creating a long-term sustainable and viable company. And I don't think any management or board would ever kind of dispute that that isn't their key objective. They need to have a good idea that basically, you know, has a purpose and is also profitable. So, you know, how do you do that? And I think, you know, where we sit today with all the complexities and challenges around reputation and also about being more responsible, both environmentally and from a stewardship perspective, you know, I think the role of both, you know, businesses and also governments and the financial community, the investors, you know, are all effectively on the line to deliver the transition. There is a myriad of participants that need to play their part in that. But I think putting that down into some actual actionable advice, you know, boards need to really push and test management as to the reasons why they've done it for the last 10 or 50 years or 150 years is the reason why they still need to continue doing it in that way. And that does set apart the aspects of compliance of ESG and the other half, which is about sort of really looking at the sort of future actions. And in a way, that is actually saying, as much as we can do this in the most cost-effective way, because what's been alluded to is the industry is already suffering from lack of investment, lack of funding, and a lot of these other challenges around the other aspects of social, reputational issues, etc. But ultimately, you know, how do we do that in the most cost-effective way? And so, you know, my optimistic view is that actually with the use of technology, we should be able to start, you know, assimilating what some of these outcomes look like and give confidence to all of the participants that actually doing things differently in the future has actually a long-term positive gain. And in a way, that should then underpin sort of a different reputation, because if that is being done with full transparency and as much data as possible and the best communication possible, then actually you're taking all those actors on the same journey at the same time in a way. So I think what is very different here is that companies are being expected to talk about things that otherwise they would not have actually disclosed in public. And so there needs to be a confidence around doing that, and also investors realise that when things do sort of slightly change track, it's not that it's sort of the wrong decision and the wrong situation, you know, to have got into. It's actually there does need to be a bit of trial and error here. But hopefully the use of technology will actually minimise the number of kind of negative outcomes and sort of misinvestments and hopefully disasters as well, if we can sort of, you know, really lean into that.
Brilliant. I'm going to take that on. I just want to advise the audience that we're going to have questions in about 3 to 4 minutes. So just get yourself ready for anybody who wants to ask a question. I'm going to take on your point a little bit further, Camilla, and maybe ask either Nick or Pavel or anybody on the panel. Perhaps we can sometimes be guilty of focusing too much on one thing, and ESG has been this huge dominant impact for society and all industry. perhaps we should look at other things, as Camilla has just alluded to with the technology, which can effectively help improve trust. The circular economy obviously has a wider impact, but are there other things? Is the industry, does it need to reposition itself? What in terms of leadership? How can younger people come up and effectively come at a different angle to perhaps improve trust? Anybody want to take up on that? I'll particularly focus on Pavel and Nick, who haven't spoken for a few minutes.
I would agree with what Camilla was saying there, and I think that's a very good point. I mean, technology is probably the answer to help out there. I mean, I must say that most of the conversations that I have with mining companies starts off with ESG as opposed to the project. So we're all talking about it. I just don't think anybody has the real answer of how to make the real change. But technology is certainly, I think, something that we could consider.
Pavel, any comments?
Yeah, maybe quickly to complement what Camilla said, with all the value in data and new technologies, I would say the good old personal communication is always very important and crucial. And you're right that ESG is a very broad field and it's easy to get lost there. But I would recommend companies, management, and boards of directors to be open to direct communication with investors and alliances of investors, with NGOs and other civil society organizations, and that will not just help you to build up your reputation and improve it, but you will also learn a lot of new things about best practices, what exactly investors and the civil society expects from companies, what things you could improve, and specifically what targets to set, how to achieve them, what the best practices are. NGOs and investors shouldn't be your enemies, they are your partners and they want to collaborate. They have been doing a lot of work and they would be more than happy to share this work with companies.
Definitely, better transparency, I think.
Yeah.
Okay.
And just if I may,
have a quick one, and then I'm going to come to Mark on one final thing.
No, just one thing in that. I think one thing we haven't touched on here really is actually the enormous amount of progress that mining companies have made in the kind of long-term injury and the safety aspects. And actually, I think just what that does is actually it demonstrates that, again, if you kind of really monitor and you're really put on the line to articulate what your strategy is around safety and what is happening, you can actually see the visible benefits. So I think, progress has already been made in certain very sort of big and important parts of ESG. And I think we need to take some confidence from that actually that sort of action and trust can actually now feed into other aspects of ESG, which are maybe harder to...
From my own experience, that just needs communication, credible communication.
Yeah.
Yes, absolutely.
In terms of being able to amplify that to the different types of investors out there, and therefore encourage new investment. I think to end on a positive, I think this has been a very positive conversation, but to end it on a 2024 vision of positivity, I was looking, Mark, at your company's, Allianz's website earlier this morning, and it highlights that that perhaps there's a new investment environment emerging, and that 2024 could potentially see more of a positive approach to some of the risker, bringing risk back in. Perhaps bring all of this in. Where are we with going forward into that, and how can the mining industry benefit from that?
I do think it's going to become easier for the industry. When people talk about ESG, there are two ways to spell ESG. You can spell it emotionally, ESG, or you can spell it unemotionally, ESG. For the last decade, we've had the first. It's been this opaque, qualitative approach. Where we see going forward is with the new data capture, very high quality, specific, quantitative measurement of E, S, and G. And I think that is to the point that was made earlier of, I don't know how to deal with this ESG thing. It's going to become easier. And I think by embracing and engaging with that evolution, the industry can really find, again, that marginal buyer of risk.
Thank you very much indeed. I don't think we've got long for questions, but maybe one quick one? I can see 37 seconds on this.
Maybe, just one quick one.
One there.
I, Edmund Jenica, DRD Gold, from South Africa. Thanks very much for this conversation about ESG. I've got a question for the panel about the 3 G's of ESG, and that is greenwashing, green wishing, and green hushing. Big effect there in terms of reputational risk, but just some of your comments there, please.
Anybody want to take that?
Well, I think we as an industry, asset management industry, have a responsibility to actually influence companies to become ESG, and I think it sort of rests with us really, because at the end of the day, it's us that's deploying that money into the market. Greenwashing, I would say it's very disappointing that has gone on, and there's been a lot of it, even in Australia. So very disappointing, but it's something that we need to address as an industry.
I would lastly on that one, the problem in the recent years is we've been asked to, the regulation has been measure, 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 even when you can't measure. And they've sidelined engagement. That's the biggest change this year, is we're now getting to a point where we can measure, and all the new regulation is really embedding the contribution of engagement and stewardship. That for me is what gives me that excitement that we're starting after what, quite frankly, has been several years of regulatory chaos into something that is a more norming phase.
Which therefore allows improved communication, credibility following that period of...
You know what people want to hear,
Yep.
so you tell them.
Yeah.
Yep. I think I'm going to be stopped anyway, but thank you to the panel this morning for this. Thank you to the audience for being here, and thank you to the organisers for having us all. Thank you.
Thank you very much.
Thank you.